Hi there, and welcome to our Pellegrini Financial third quarter market update call. And happy Halloween out there for everyone who's going trick or treating or handing out trick or treats tonight. So hopefully, don't eat too many yourself. Um, when getting to the market update, well, we had a good quarter again here in Q3. It carried on really after quarter two. July had carried on with where June left off. We had a little softness in the month of August, so it was a bit of a flat month, and then September picked up again. So as a whole, Q3 was a good performer throughout that time frame. And this time around, perhaps led a bit more by the Canadian market. So when we look at some of the equities globally, the Canadian market was a stronger market. The U.S. was still a strong market as well too, and particularly the Russell 2000. There, I didn't highlight that, but that's more of the small cap index in the U.S. was a good performer. In some of the other markets that were maybe not as robust, we saw the Nikkei or in Japan there that was more of a negative performer, still positive year to date, but had a tough Q3. The euro was pretty much a flat market as well too. And then some of the other markets generally there's nothing significant within that whole chart there. Soft performance, but mostly robust returns on a year-to-date basis across the board. When we look at sectors in particular, and this is more specific to Canada this time around, of course, but we had really in the Q3 financials and the real estate market in Canada that performed the best in this time frame. But materials and energy are still the strongest performers on a year-to-date basis, as they obviously make up a good chunk of our Canadian index as well. And in the U.S. market in particular, of course, technology we've talked plenty of in the past year has certainly been a strong performer and carrying on in that fashion as well. When we look at some of the interest rate and inflation aspects. Interest rates in particular, of course, in Canada, we saw now the fourth rate cut here on a year-to-date basis, and a bigger rate cut, 50 basis points or 0.5%, so bringing down that Bank of Canada rate to 3.75%. That obviously is a boon in the immediate or near term for certainly people with lines of credit. Obviously, consumers in particular, of course, that'd be a beneficial aspect. Businesses, of course, and mortgage rates. It'll impact that, and you've seen mortgage rates come down here over the last few months. Um, the U.S. now, of course, they've cut rates once, and I mentioned last time they're not going to cut rates in or around an election, so they've been avoiding this time frame in particular. But the expectation, of course, once this election is done, they'll get on that rate cutting bandwagon very quickly and play a little catch up themselves, perhaps. And this rate cuts right now is really in part because this bottom chart here, which is inflation, has come down to that target level of 2%. In Canada in particular, the core inflation has gotten down to that target level of 2%. The US is still slightly above that, but the trend line is there. And so that gives all central banks, Federal Reserve and Bank of Canada, all these different central banks, the opportunity to cut rates. So that rapid increase of interest rates to combat inflation did its job and had done it well at this point in time. Because when we look at the next chart here, we talk about employment numbers and GDP. The biggest thing was not ensuring or not trying to create a recession in either economy. And so, employment wise, we saw this top chart here, which is the unemployment rate in Canada, had been increasing through the course of the year for the most part, and including in Q3. September's was a good jobs number, so you saw the unemployment rate come down. And that was the same in the US. Their numbers actually were quite a bit stronger, especially for job gains in September. Their overall employment rate, again, is not as high as ours. And so that's been good news. The bottom chart in particular, again, is the one where economic growth and GDP. That has obviously trended a little higher in Q3. As a whole, we saw, of course, not very robust numbers through 2023 and 2024 in the early parts. But the key was there's no recession. We got near it, but there was no recession. Again, the economic numbers in the U.S. are a little bit stronger than Canada, but as we get into 2025, the expectation is GDP to be 2% or more in Canada. And again, so that Goldilocks scenario of increasing rates, getting inflation in check, which has happened without creating a recession of any kind, seems to be the way it's gone out so far. So that's all good news. When we look at commodities, Put two different charts up here, one on oil, which I haven't looked at for a little while now, but the trend line has been down over the last 6 months, and yeah, somewhat surprisingly, maybe with some of the recent Middle East issues going on. However, we're still around that $70 a barrel threshold. Maybe the other aspect of that too is Western Canada Select, of course, which is what we price our Western Canadian oil at, still has a spread of $15 a barrel roughly. So it still has not um, been reduced or narrowed in any way, even with the new pipeline open. When we look at metals, I just put up spot gold here, which historically has not gotten through that $2,000 an ounce level. From the start of 2024, it broke through that and has been on a run ever since. So we see now up to $2,740 an ounce. That's been something that we don't really get into from an investment perspective, but always an interesting story to talk about. And other metals have performed quite well, copper in particular as well here for base metals. So when we look at the Q4 coming in, I don't see a whole lot of changes happening in how markets are trending. The upward trend is still there. I can see some, again, softness near and around this election coming up in the U.S. I know people will talk about it more than they probably need to, and headlines will probably drive some of those conversations. I've been trying to caution people to not read too much into whatever election result comes about. Any markets reacting to that are knee-jerk reactions. I think economically everything is strong enough and robust enough underneath it that market performance should still go positively, especially when we see rates being cut. So rates have an impact both on the fixed income market because as interest rates rise, bond prices fall. But now we're in that inverse where interest rates are falling, so bond prices will rise. That's a good thing. And lower interest rates are good for business, good for consumers. So that drives economic numbers, and that's all positive. And so we see that happening across the globe. I think that's a good thing at this point. And as a whole, again, we're on top of always monitoring and evaluating our performances in regards to the mandates that we positioned with each of you, and understand that those financial objectives that you are trying to achieve are based on us who monitor, make adjustments or changes as need to, but ensuring that overall mandate and those investment performances and portfolios are meeting what your objectives are. So again, we thank you for that partnership. And again, we thank you for joining us in this Q3 call and look forward to Q4 in a few months' time. Bye for now.